Bitcoin is the base layer of the cyber economy. It doesn't need the innovation. What are we doing here that is innovative? Well, the explosion of ETFs wrap Bitcoin. It has brought the premise of Bitcoin, or the promise of Bitcoin, to somewhere between 50 and 100 million beneficiaries in the past 2 years. That's innovative. $150 billion of capital has flowed into that. Okay, what's the Bitcoin performance for the past 5 years? 39%. Ever since we got in this business, Bitcoin has appreciated 39% a year ARR, more than double the S&P. Okay, so why don't 1 billion people just all buy Bitcoin? It's because the volatility is 40. It's 40 times the volatility of a money market.
For most investors, Bitcoin is still viewed through the lens of price. They watch the charts, celebrate the rallies, fear the corrections, and debate whether the next cycle will look like the last. But Michael Saylor believes something much bigger is happening beneath the surface, something that has very little to do with short-term price action and everything to do with the future architecture of global finance. In Saylor's view, innovations like STRC are not simply new financial products. They represent an entirely new way of connecting traditional capital markets to a digitally scarce asset. Critics argue that Bitcoin remains too volatile to become a foundational financial instrument. Yet, the counter-argument is becoming harder to ignore. Institutional demand continues to grow. Corporate treasuries continue to emerge, and capital is increasingly searching for assets that cannot be diluted by political decisions or monetary expansion. To explain this transformation, Saylor often points to the Manhattan analogy. Imagine owning a piece of the most valuable property in the world, decades before everyone else recognizes its true worth. The value wasn't created overnight. It emerged as more people competed for a finite asset that could not be replicated. Bitcoin, according to Saylor, operates under a similar principle, except its scarcity is mathematically enforced. Whether one agrees with his thesis or not, the implications are difficult to dismiss. If Bitcoin continues evolving from a speculative asset into a form of digital capital integrated into global financial infrastructure, the market may be witnessing the early stages of a transition far larger than a typical bull cycle. Listen carefully to Saylor's insights next, because his argument isn't merely about where Bitcoin's price is headed. It's about why he believes Bitcoin could fundamentally reshape the way value is stored, transferred, and preserved in the decades ahead.
I give you Manhattan, there's granite, it's been there for 200 million years, and some dude wants to cast a spell to turn the granite into steel or copper or cotton candy because he wants to. And you're like, that's pretty stupid. Just leave the granite in Manhattan. You want to innovate? Put a building on the granite. You want to innovate some more? Change the building. You want to innovate some more? Put a company in the building. You want to innovate more? Upgrade the technology that the company runs on in the building, on the granite, in Manhattan, right? You can have much higher frequency innovations above the base layer. Our company created a Bitcoin-backed security, basically amplified Bitcoin. Last we checked, we had 55 million beneficiaries on the equity MSTR. Another innovation. But the most interesting one, I think, is that we've done is digital credit. And the idea of digital credit is, can you give a bank account to 1 billion people that pays them 10% without volatility? Who wants that?
Everybody.
They can't stand the volatility, right? It's too scary. The performance is fine, but you cannot get anybody to agree. Even sophisticated financiers will not agree to buy Bitcoin. It takes 1,000 hours of discussion to sell an asset appreciating 40% a year with a volatility of 40. Like, how many people want unlimited free electricity?
Everybody.
And how many people want to run a nuclear reactor in their backyard?
Not very many.
So we're running a crypto reactor, right? The real unlock is we'll just run the crypto reactor. We've invested $60 billion in a crypto reactor. Now we can turn around. If we have $60 billion of capital, if we have, that much equity, for every dollar of equity, you can sell 10 to 20 cents of credit. So we can create $10 billion to $20 billion a year worth of a high yield bank account backed by Bitcoin. And that will grow 30 to 50% a year. And so the people that want that are retirees, 20 something. The truth of the matter is the only security that I've ever created that I would ever recommend to friends and family is STRC. Like to my brother, to 20 somethings, to retirees. They're like, well, what should I buy? The Bitcoin, or should I buy MSTR, or should I buy STRF or STRD? I'm like, or convertible bonds. Like, those are all good investments if you're a professional investor, but you have to have a 4 to 10 year time horizon, and they're very sophisticated. You have to understand delta and duration and liquidity and the like, and you might even have to be a qualified institutional investor. It's illegal for a retail investor to buy a convertible bond, right? So they're all complicated, but let me give you this simple one. This one, it's designed to trade around 100, and if it falls below 100, the company's going to use all of its capital, all of its efforts to get it back to 100. Okay. And so it's the simplest possible. It's a 15-second sales pitch. It's 5x over collateralized by Bitcoin. So the risk is Bitcoin goes through zero tomorrow forever. You bought a note or a credit instrument on a building in Manhattan. And the risk is, will Manhattan sink below the ocean? And if so, you're not going to get your monthly payments. Or will the building manager set the building on fire? Right? And so you've got the risk of the issuer strategy and the risk of the underlying capital asset. And you have to get comfortable with those two risks. The reward is, instead of getting paid 2% after tax, you get paid 10% or 11%, tax deferred. So that's the benefit. Now, of course, there are countervailing risks. If you have money and you don't put it in digital credit, you're going to put it in a building, you're going to buy an Airbnb, you're going to buy the S&P index, and the S&P index is going to go up and down. So you're either taking equity risk or you're taking property risk, or you can buy a government bond, which has no theoretical risk other than the collapse of the government, but it has a negative real yield. It's like it's guaranteed to underperform the cost of capital by 4 or 5% a year. So you're just getting poor slowly over the course of 20 years. We invest in Bitcoin forever, and we never realized that capital gain. We never realized that tax obligation. We don't have to pass that through to the credit investor. So if you're a credit investor and you value principal protection and stability, but you also want to compound your money tax deferred, the way Stretch works is you buy a $100 share, the first $100 worth of dividends will be tax deferred as long as you don't sell the instrument. If you then pass the instrument to your heir, they get a step up in basis and their next $100 become tax deferred. So you could, in theory, go 20 years without getting taxed on the dividend between you and your heir. And if you actually calculate the benefit, if you were to reinvest that, the compounding benefit is pretty extraordinary compared to most other credit investments.
The only risk in Strategy's STRC is if Bitcoin goes to zero. That's a remarkable statement when you really stop and think about it. Because the real question is this: can Bitcoin actually go to zero anymore? Critics would argue that every asset carries risk and nothing is guaranteed. Yet Bitcoin today is operating in a vastly different environment than it was years ago. Institutional adoption is accelerating. ETF demand has opened the door to traditional capital. And corporations, funds, and even governments are beginning to take it seriously. That doesn't mean the path forward will be smooth. Volatility remains, and skepticism is healthy. But the bullish argument continues to strengthen as adoption expands and supply remains fixed. Perhaps that's what Michael Saylor is really pointing toward. What do you think? Could Bitcoin ever go to zero? Or has that possibility already become increasingly unlikely? Let us know in the comments below. If you enjoyed this video, like, share, and subscribe for daily Bitcoin and crypto insights. Thanks for watching.